Good morning, everyone. Let me welcome you to this webinar. My name is Dr. Justin Amase. I'm the Managing Director of Macrostrat, Nigeria Limited. The company is a firm of policy and governance, as well as research consulting. Now, the objective of this event is to allow our distinguished panelists to unpack the CPI numbers that were released yesterday by the National Bureau of Statistics. I have the privilege of having in our midst a distinguished economist and expert who will be our moderator. And he's no other than Dr. Chukwuka Onyekwena. Doctor, you are welcome. Dr. Onyekwena is the Executive Director of the Center for the Study of the Economics of Africa. CSEA is one of the foremost think tanks in Nigeria and in Africa. So, Doctor, you are welcome once again. I would like the panelists to put on their video one by one and introduce themselves. So, starting with Mr. Mosi Tomitokwe, you're welcome.
All right, good morning, everyone. Thank you for joining. I'm Temitope Mosi, and I currently work at VNL Capital Asset Management as the head of research and strategy. Thank you.
Thank you. The next panelist should come up.
Good morning.
Good morning, distinguished ladies and gentlemen.
Good morning, Dr. Amasi. My name is Dr. Islainuddin. My name is Dr. Islainuddin Mohammed. I head consulting from Tri-Speed Consulting. Prior to that, I was the chief economist of Bank of Industry. Thank you. As well as an immediate past council member of Nigerian Economic Society.
You're welcome, Doctor. Next.
My name is Salamatu Idris Isa. I'm an economist from Ahmadu Bello University, that's Department of Economics, and a member of the Nigerian Economic Society Council.
You're welcome.
Good morning, distinguished ladies and gentlemen. Good morning, everyone.
Good morning, Prof. Good morning.
Okay, my name is Gimba Victor Kyari. I'm a lecturer with Kaduna State University, and I'm a member of Nigerian Economic Society. Thank you.
Thank you, Prof. Next panelist, please.
Good morning, ladies and gentlemen. My name is Samson Simon. I'm a research fellow at Macrostrat. Thank you.
Good morning.
Thank you, Dr. Simon. Next panelist.
Good morning, everyone. My name is Modestus Chidi Nsongu, a lecturer with Veritas University and secretary FCT Chapter of NES.
Thank you, Doctor. Next panelist, please. Okay, if there is no other panelists available, let me call on the chairman of the Nigerian Economic Society FCT Chapter, Dr. Peter Agunloye, to welcome us and give us the protocols that are required to be followed for this discussion. Dr. Agunloye, the floor is yours.
Yeah, good morning, all esteemed personalities on board. My name is Dr. Peter Agunloye. I'm the FCT Chairman, Nigerian Economic Society, FCT Chapter. So I welcome everyone to this all important webinar My task at this point is to draw attention to the rules that will shape this discussion. So, and I want us to know that we have only one major constraint today, and that is time. Okay. So once again, on behalf of the FCT chapter, I welcome all of you to this webinar. So the programs will be in 3 segments. So the first segment will be on analytical presentations by the panelists. So, and that will take 5 minutes each. So we expect each panelist on that section, segment 1, to make their presentation within 5 minutes. So please, we plead with you to please keep to time. So, and then we expect each panelist to make a predictive takeaway, a kind of summary after their presentation. So we encourage everyone to put on their video while they are on, and everyone should switch off should mute their audios. Everybody should mute their audio. So please, so that we can hear ourselves clearly. Now, after segment 1, which is analytical presentation by panelists, we proceed to the second stage, which is panel discussion. So at this point, the moderator will pose questions to the panelists. So we expect each panelist to respond within the time allotted. So we please encourage you to just go straight to the point and make your submission. So we proceed from that second stage to the last stage, which will be questions from the audience. So I don't know if you have audience on ground now, but then maybe from time to time we post this so that we expect them to give questions or make the observations known to us. And in case, if there's, whenever audience is making any submission in terms of questions, we please implore them to make it clear the panelists they are addressing their questions to. So the panelists, please take note as soon as they are raising their questions and it's been addressed to you. Okay. So as a general rule, please, once again, we encourage you to mute your phone. And the timekeeper will keep to time. So please, the timekeeper will act immediately after 5 minutes given to you during your presentation. So we employ, please keep to it so that we can have a very robust discussion. So I think that is it from my end. So once again, on behalf of FCT Chapter of Nigerian Economic Society, I welcome you all to this all-important webinar on CPI report. Thank you so much.
Thank you, Dr. Agunloye, Chairman, FCT Chapter of Nigerian Economic Society. I will now invite our distinguished moderator, Dr. Chukwuka Onyekwena, to take the floor and run the proceeding until the last point when some of us will come in. Dr. Onyekwena, the floor is yours, please.
Right. Thank you, everyone. Pleasure to be here. Good morning to you all. So I'm happy to moderate this session. So this session will focus on the coordinated sets released yesterday by the National Bureau of Statistics for July 2026. So Nigeria's inflation picture is one of sticky headline inflation, with food prices as the main pressure point. Headline inflation was broadly flat at 15.91% in June, and core inflation eased to 15.92%. Food inflation rose to 17.52%. So the key concern whether food, transport, and input costs are feeding into business prices, wages, and wider inflation, while weakening household purchasing power. Headline inflation has shown structural persistence, moving the market curve significantly. The primary driver remains food inflation, which continues its volatile run due to localized transport shocks and input scarcity. Meanwhile, core inflation, excluding volatile agricultural produce, demonstrates that monetary liquidity effects are deeply entrenched in the non-farm economy. So now from business as usual operations. So with that introduction, I'll move on to the first panelist and Temitope Omosuyi for his analytical presentations.
All right. Can I go in?
Yes.
Hello?
Yes, go ahead, Temitope.
All right. Thank you very much, distinguished members. So I'll be speaking to the numbers, and I think it's quite interesting to know that Nigerian inflation, 15.43%, and it's really quite instructive, especially because my experience is from the financial market, and I'll be looking at it from that angle, right? But I think one important factor that we have to look at is the fact that food inflation is still so much elevated at 20%. Analyzed CPI, analyzed inflation, that is relatively high compared to what we've seen so far in the year. So, but for the financial market, this is what we are thinking about, because we typically look at two things. One, long-term inflation, and the second one is inflation expectation. However, in between all of those, we also try to look at real yields. So for long-term inflation expectation in Nigeria, long-term inflation expectation here, I mean 10-year inflation average. So before 2022, 10-year inflation average in Nigeria was 13%, right? But right now, if you include for the last 10 years, including the recent inflation number, the 10-year average has gone up to 18%. That means a lot for every areas or every area of the economy, from cost of funding business. For instance, if any company wants to go to the financial market today to raise funding, it will be priced on top of risk-free rates, and risk-free rates are around, especially yields on treasury bills, are over 20%. So if inflation remains elevated, it therefore means that cost of funding for businesses will remain elevated. But when it comes to real yield, that is where I play a lot, which is the financial market, in terms of buying and selling of financial instruments. So investors are paying a lot of attention to what is happening to Nigerian real yield. The decline in inflation, the recent number we saw from 15.91% in June to 15.43% in July, while that is commendable, one has to pay a lot of attention to the underlying movement. And I typically will look at that from the month-on-month numbers. In fact, what I would do is to analyze the numbers. So if I analyze the month-on-month change, especially for food inflation, that means inflation actually went up by 50% for food inflation. If you analyze the 5% month-on-month change, and if you also analyze the month-on-month change for headline, is also somewhat high, somewhat higher than 13-14%. But I think what is even more important is where inflation is going before the end of the year. So, and the way to look at it is also month-on-month. So if you plug month-on-month number, 1%, for instance, the last number we saw, July number, month-on-month came in as 1.5. So even if we assume 1%, and that is up extremely optimistic, inflation before at December, by December, inflation will go to 15.8. And if we take 1.5% inflation month on month, that means Nigeria inflation would end up at over 17%, in fact, close to 18% in December. And the assumption is very reasonable. 1% or 1.5%. And the reason is because so far this year, as a matter of fact, we have seen on average, month on month has gone up by 2%. That means my assumptions are extremely optimistic. That is 15.8% forecast for December, and between 15 to 18% are very optimistic, because last year, month-on-month number exceeded 2%. And if you go 2 years ago, 2024, it's usually are close to the 2% level. So, and it therefore means that we may begin to see uptick in inflation from next month. And the major reason is because of base effects. Like I mentioned, if you look at from August of last year to December of last year, month-on-month inflation was less than 1%. It therefore means that if we want to bring down inflation, if inflation is going to decelerate, I mean year-on-year headline inflation, then we must get month-on-month that is lower than 1%. But that is not realistic due to a lot of factors. And the one singular factor I'll talk about because of time is the impact of energy crisis that we are seeing. Just this morning, yesterday into this morning, oil prices have gone up to Brent crude have gone up to about near $100 per barrel again, because at some point we're celebrating that the whole war in the Middle East, because there was a time that the US had some sort of agreement to cease fire, and that took oil prices from about around 100 at the touch in March and April, to around the 70 levels. But right now, today, as I speak, the oil price, Brent is now closer to 100. That means the inflationary pressure, the part I've talked about is still base effects. I've not added the impact of this renewed jump in oil price to the conversation. It therefore means that we should not even think about anything lower than 15% for inflation in 2026, even though the CBN thinks that inflation would, when the forecast was done, I believe they didn't take into cognizance of this energy shock. They're thinking about 12% inflation for the year, by the end of this year, but that seems unrealistic. But when it comes to real yield, why does this matter? It matters because one of the reasons why we are seeing a major stability in the FS market is as a result of the direction of inflation. Nigeria's inflation has declined massively from 23%, over 30% in 2024, right, to 15%. And that means real effective exchange rates, in addition to the Naira devaluation that we saw in 2024, and we saw a bit of that, especially 2024, 2023, and 2024. Naira has remained largely undervalued. But because inflation is rising, it therefore means that the undervaluation is becoming slimmer and slimmer. So as I speak to you, by my estimation, the Naira is just only undervalued by about 20% compared to say some months ago, right, where the undervaluation was about 40%. So inflation story matters because it matters to exchange stories, and exchange story also matters to inflation, because one of the two major drivers of inflation in Nigeria, it has been empirically tested, are one, money supply. Growth in money supply was what brought us to where we are today because of two things. One, when government financed the economy massively in 2020 as a result of the COVID, government went overboard with fiscal deficit because of the spending. And we also saw similar spending that happened up until 2023 as a result of ways and means. Money supply growth were up significantly by more than 40-50%. As a matter of fact, if we do a simple correlation, we'll see that there's a strong correlation between money supply growth and inflation in Nigeria. So it therefore means that those money supply story affected inflation, and the direction of money supply is also going to be a part of the story, and exchange rate is also part of that. So by and large, we are thinking that inflation would remain elevated for the rest of this year, and that would be a major factor in pricing for investors, and in pricing of financial asset classes for both domestic investors and foreign investors. And that's why we see that even the yield in the financial market are somewhat elevated, despite the fact that we saw a bit of decline in yield within the last 1 month. But so far, so good. Yield are still quite elevated, over 20% at the OMO market and treasury bills, and for the bond market, still over 15% at the long end of the curve, and over 17% at the short end of the curve. So I think I'll have to stop there because there's a lot to talk about. Thank you.
All right, thank you to for those insights on the effect. is the ways and means and the COVID days. So thanks for those insights. So moving on to Dr. Islamuddin Mohammed. You are for this. Dr.
Okay.
Islam.
Yes, I didn't hear what you want me to talk about. I didn't hear the question you asked.
Start off with the question just for your own remarks on the rise in inflation. There'll be a time for specific questions.
Okay. I think in analyzing the inflation figures, one could see that minus rebasing year-on-year inflation rate has you can see a decline. Maybe it was 24.94% as of July last year. Now, second, we also need to take into cognizance the fact that the inflation figures were as at half one of July. And towards the later part of July, we have seen escalation in the crisis in the Middle East, the US-Iran conflict, and we know that we cannot be insulated. Majorly, when you look at, you can easily link it up to food inflation, for example, minus Strait of Hormuz being the major choke point for supplies of helium, for example, medical products, or crude oil, 20% of crude oil, which may not directly impact on us. It can indirectly, because while we have stability in crude oil, petroleum prices, for example, is because we have Dangote refinery, and Dangote refinery do import. So we cannot be insulated what is happening in the international market. And again, also, that choke point is a major route for 30% of fertilizer export. So we can see the linkage with inflation. And we also know that our own inflation is rather structural. It's not actually demand pull inflation. It's not as if people are just buying anyhow they want. It's a cost push supply side inflation due to some structural factors, and that informs the kind of the hawkish stand of central bank over the last 3 years or thereabout to tame inflation, to the extent that they have succeeded in moderating inflation, but as we will come to see, it's to the detriment of growth. For example, in attempting to tame inflation, CBN imposed a CRR of 45% of banks. That means for every 1 naira that a bank holds, 45 kobo of it is quarantined in central bank at 0 interest rate. And the remaining balance is what is available for banks to lend to the market. And do the banks really lend, given the structure of the economy? Even the 55% available, you find that banks have difficulty in lending because of the high interest. Remember, MPR, because of has been rather at the upward direction because of attempt by CBN to control inflation, control liquidity. And so there is no incentive for risk taking in terms of lending. That has created impact on development of the market. The SMEs are having big problem because even if they can lend, who will borrow at over 30% and expect to make any income? So it's very difficult for the banks. There's the CRR challenge, the high MPR challenge, and the interest rate at above 30%. The only incentive, the only place where you can see why we're seeing macroeconomic stability is because, like the last speaker spoke about, the fixed income market is doing very well because there is an incentive to invest in treasury bills. There is incentive to invest in the bond market because of relatively high interest rate. Even that now somehow for the local market may be challenged because of the wide gap between inflation rate, current inflation rate, and the MPR rate. And if that rate is very low, there may be this incentive because there may be investment in kind of a negative interest rate. So I expect, my own thinking is, because of the challenges that are happening now in the market, especially as it relates to the international market, the war in Iran, US, which has become like a cat and mouse war over the last few months. And because of the accentuation increase in the level of crisis at the second half of July, I expect that the August numbers may be a little bit higher. So it may be really, really difficult. I'm not saying it's impossible, because all these things, CBN didn't consider that there may be this war before they predicted 12% by the end of the year as expected inflation rate. So I am not saying that, but given the current scenario, things being equal, unless the situation changes, CBN might not be able to meet up with that specific target. Rather, we'll see further uptick in level of inflation rate. Thank you.
Those very useful insights. The inflation that we're experiencing has caused to pool. That's and also mention the hawkish stance of the central bank, and with rising interest rates and its implication on various aspects of the economy, especially in banks. And so thanks for that. We move on to Professor Kim. Expecting Professor Gimba Tar.
Yeah, good morning, ladies and gentlemen. My name is Gimba Victor Kari, a lecturer with Kaduna State University. Well, I'm going to speak on fiscal policy coordination and structural deficit. The focus is on the budgetary assumptions, debt servicing strength, and the inflation expansionary fiscal friction points. Now, let me start by asking a simple question. What does high inflation mean for government's budget? The simple answer is that when prices rise, the purchasing power of government's budget falls. For instance, if a road or school or a hospital was budgeted for a certain amount of money at the beginning of the year, naturally, if that project is not executed at that very material time, by the time you spend 2-3 months, you'll find out that you will not be able to use the same amount of money to execute that very project. And therefore, this is the cost of inflation against our budget in Nigeria. And we all know that sometimes budgets are being drafted or budgets are being announced, but the implementation becomes very difficult. I think, to the best of my knowledge, we are still using the budget of 2025. I stand to be corrected anyway. So the inflation does not only affect household, it also reduces the real value of public expenditure. Though Nigerian inflation, when you look at it presently, it has improved a lot, because from 2023, 2024, 2025, you agree with me that the inflation has declined significantly. However, inflation still remains significant in 2026. We have seen the July headline inflation rate drop at dropped at 15.43 from 15.91 in June, while food inflation added 2.79 to stand at 20.31 in July, from 17.52 in June. Therefore, this will naturally affect other sectors or affect government expenditure, because government budget is actually not, is not actually outside what is happening, or rather the inflation that we see. Government budget actually is being affected by inflation. Additionally, the issue of debt servicing strain. Government needs to borrow money when revenues are insufficient in order to finance expenditure. However, high interest rates make domestic borrowing more expensive. For instance, Nigeria faced severe pressure with a debt servicing revenue ratio hovering around 60%, which is actually an improvement from previous years. We saw that previous years we had about almost 90% debt servicing ratio to revenue generation. Meanwhile, CBN maintained the monetary policy rate at 26.5% in July, while its restrictive monetary strain can help control inflation. It is also a negative effect, or it is also a cost to government borrowing, because government will not be able, or businesses will not be able to thrive well when you have a very high interest rate. Businesses, or rather investors, will not be able to borrow money at a very high interest rate. Furthermore, unrealistic government budgetary assumptions is another serious challenge in public expenditure. Nigerian federal budget routinely rely on inflated revenue forecasts. We hear of legislative budget padding, unachievable non-oil collection targets, and over-optimistic crude oil production benchmark. The crude oil production benchmark for this year was pegged at 1.8 billion barrels per day. But currently, Nigeria is under production, or rather, we are producing less than 1.5 barrels per day, which drastically will affect government expenditure. This disconnect between planning and economic realities triggered severe funding shortfalls, heavily debt pressure, and widespread under implementation of capital infrastructure. Then this leads to capital vote starvation and rising deficit, and it also affects projects, and that is why we see abundant projects, incomplete projects here and there in Nigeria. This brings us to the importance of fiscal and monetary policy coordination. The CBN is using monetary policy to control inflation, while government must manage its spending and borrowing responsibly. If government continues to run large deficits and relies heavily on domestic borrowing, it can place additional pressure on interest rate, liquidity, and inflation. Therefore, monetary policy cannot work in isolation. Fiscal authorities must support the fight against inflation through prudent spending, stronger revenue mobilization, efficient borrowing, and better prioritization of public projects. The key issue is not simply how much government spends, but what that spending achieves. Government should protect projects that have greater economic and social value, not just anyhow project, particularly infrastructure, health, education, agriculture, and projects that have direct bearing to the public. Thank you for your time.
All right, thank you, Professor Gimber. Sorry for those remarks from the fiscal policy angle. The need for monetary policy to be complemented by fiscal policy and effective budgeting, and how inflation distorts the budgetary. So moving on swiftly to Dr. Modestus Nsong. Dr. Modestus, I invite you to provide the perspectives of corporate strategy, supply chains, and procurement. Dr. Modestus.
Good morning, the moderator. I am Modestus Nsong, a lecturer in the Department of Economics, Veritas University, Abuja. The moderator have told us the sub-theme I will be discussing on. One thing we should understand is that when we talk about inflation or cost of living crisis caused by inflation, we often focus on what inflation means for households. But there is another side of the story. What does inflation mean for firms that produce these goods and services that households consume? You find out that the rising costs most times start from the firms, particularly those that produce consumable goods. So my focus, therefore, is on how the July CPI as released is transmitted through corporate supply chain, procurement, and ultimately corporate margins. So for businesses, the critical issue is not simply the inflation rate. It's not simply the inflation rate. It is how quickly the rising costs move, should pass through the supply chain, and how effectively firms can respond before these costs erode their margin. Yes, we find out that in a time of inflation, a product you buy for 1 naira today, and your margin is 2 naira, you are selling it for say 3 naira, and you will not be able to go back to replace those stock, those inventories, because of inflation. So the first issue is the inventory replacement velocity. In an inflationary environment, the relevant question for a business is not only what it paid for inventory yesterday, but what it will cost him to replace the inventory tomorrow. So for instance, like I've said, if a manufacturer, for instance, bought an input for 100 million, and by the time the inventory is exhausted, replacement costs have risen to 125 million, for instance. The company faces a 25 million replacement cost gap. And if it prices its product based on the old cost, it may appear profitable, but actually be losing purchasing power, due to the effect of inflation. Therefore, I think companies need faster inventory monitoring, better demand forecasting, and deliberate balance between holding enough stock to hedge against inflation and preserving their working capital. the punchline I'm trying to make here is that in inflationary environment, inventory not just become stock, but it is a financial risk. You know, it's a financial risk in the sense that if the manufacturer or the firm fail to balance the equation between holding the stock and their working capital, then they see themselves losing their working capital. So the second issue here is manufacturing input pricing. The CPI will always tell us what is happening to prices generally, but every company has its own inflation basket. In Nigeria, the major Nigerian cost pressures arise from the raw material these firms use in production, imported inputs, energy, transportation and logistics, packaging, labor and financing costs. That's cost of borrowing. So there is no single corporate inflation rate. Yes, we can talk about CPI inflation rate being 15.43. For corporate organizations, for firms, there is no single corporate inflation rate. A manufacturer that imports 60% of its input will experience inflation very differently from the one that sources most of its input locally. So this is particularly important in Nigeria because exchange rate movements can quickly transmit into imported input costs. A weaker naira can therefore increase production costs even before those increases become visible in the headline CPI. So this makes procurement a strategic function. Companies need to think about supply diversification, local sourcing, contract design, bulk purchasing, payment terms, and inventory strategies. Not simply about getting the lowest price from a supplier. You know, if you talk of getting the lowest price, it might not be the cost of, you talk of the environment procurement is no longer simply about buying cheaply. It is about managing costs, supply, and then the price risk. So we try to manage the cost between the one you are buying cheaply and the home cost. That is the cost of bringing those inputs at the production factory. You know, sometimes you source it and you say, okay, it's cheap to buy from this source, when actually to bring it down, the cost of bringing it down due to logistics and others will make it so expensive. Like in importation, yes, it's cheaper in China, but by the time you bring it down here, you see that if you have sourced it elsewhere, it will be far cheaper than what is selling, what we are buying it from Ghana. So the third and perhaps most important issue in margin defense, when input cost rises, somebody have to absorb this thing. That is I'm talking about the margin defense. That is firms defending their margin and at the same time retaining the demand for their products. Because when your cost is high, definitely the demand for your product will fall. So the pass through here is that companies increases its price, protects its margin, but the risk of losing demands because consumers are already under cost of living pressure. So they will go for the alternative. So companies improve productivity, renegotiate suppliers, reduce waste, substitute inputs, localize where possible, and improve inventory turnover. So I will want to argue here that this option of trying to localize your input is most sustainable in Nigerian businesses than increasing the prices. You know, the winning firm will increasingly be those that can do both. That is, you protect your margin through productivity and then supply chain efficiency, while keeping your prices low within what the market can absorb. And so, in the end, the take home here is that if we move beyond the headline CPI for this month, that's the CPI number, the corporate story is really about three things: how quickly inventory has to be replaced, how rapidly input costs are moving through supply chains, and how effectively companies can defend margin without destroying demand. So for Nigerian businesses, inflation management is therefore becoming a core competitive strategy. The firm that will be most resilient are not necessarily those with lowest cost today, but those that can anticipate cost management, that can anticipate costs, manage their supply chain, turn inventory efficiently, and dynamically defend their margin. So that is it. In as much as a firm will want to maintain its margin, that is profitability, it should consider the demand for his products, because in the course of trying to defend your margin, you see yourself losing clients and you see yourself actually losing that profit. Thank you.
Thank you very much, Dr. Modestus, for those useful insights on how firms react to inflation strategies, um, and implications of their strategies. Thank you very much. Let's move quickly to Professor Salamatu Idris Issa. Professor Salamatu, you have the floor. You're bringing perspectives from agricultural, logistics, and food security.
Okay. Good afternoon. Thank you very much, my colleagues and the participants for this debate. In recent times, we have seen a lot of shock within the economy, and most of the narrative is that the economy is doing well, but we can see that what the inflation rate is still telling us is that it is 2-digit, and that also shows that the numbers also shows that the food inflation is even higher than the headline inflation, which is food inflation is 17.5%, while the headline inflation is still 15%. And the food inflation in the rural area is more than that of the urban area. The rural is 17.2%, while the urban center is 16%. So that tells the story. And if we say the macroeconomy indicators are telling a success story, then this particular indices of inflation, either the headline or the core inflation or the food inflation, is a different narrative, because when an economy is progressing, what you're expecting to see is that the people are better off. But in this case, with looking at the food inflation and the rural inflation rate, we know that things are not the same. There's economic imbalances between the rural areas and the urban centers. And what brings all this is the situation in which we find ourselves, especially where we have issue of subsidy removal. Even though many have said that subsidy removal is not an economic policy, but rather its function as a social safety net, that the population with low wages, poor public transport, and epilepsy power supply are supposed to be better or help assist when we have inflation rate. But we all know in Nigeria that all this that I've mentioned, they are not safe haven anymore for citizens because of the cost of logistic and cost of food in Nigeria. And this is associated with many factors, especially the transportation fare, the cost of electricity, the cost of doing business in Nigeria, which has actually affected the cost of doing business as well. So when we look at inflation rate still within 2 digits, even though it's coming down, we can also picture what if the inflation rate was just a single digit? What would have been the cost of transport? What would have been the food prices in the market? And what would have been the life of citizens in the rural area or the urban centers? So the major key factors that is still playing much to affect these causes is we still have bad roads in most rural areas. When you have good roads, the cost, the transaction cost of moving your agricultural produce from rural area to urban center will be less. And then we still have, last year, for example, we still have some policy effects where some of the foods items were imported, and that affects our local farmers in terms of revenue because the expectation, I'm not saying the policy was not good because towards the end of 2025, the prices of some of the staple foods actually came down. But before then, we could have waited for what our farmers would have benefited if that particular policy at that particular point time was not taken. So if we want to actually extensively look at how we have fared so far and how these agricultural food prices have gone out, we also have to look at the scale. The large scale farming in Nigeria is still a dream because many of what we consume or what we produce is still coming from smallholders farmers whose transaction cost is still very, very high. And then, and with the insecurity in most of our rural areas where the agricultural produce come from, many of the commercial farmers have actually closed down or collapsed because of the insecurity, especially nobody wants to be on farm where bandits will attack him or kill any of his staff. So many of these commercial establishments have actually collapsed, especially in the north. So we can see with bad harvests coupled with high transaction costs are actually influencing this inflation, food inflation in Nigeria. And we actually need to look at those cases and strategize how we can overcome it because there's not going to be any increase in agricultural demands, agricultural production when we cannot even meet our domestic production, then we cannot export. And with insecurity, it's still very, very, very high. Every day you hear whether in the productive states like Benue, Plateau, Sokoto, Zamfara, they are all still facing one insecurity or the other. So when we are expecting that if we want to be optimistic about the production or reduce the transaction costs, we actually need to strategize on the insecurity perspective because that is where the ball game is. If we cannot control this insecurity, there's no way we can, and there's no way the cost of production or the cost of food prices will come down. And then we also need to look at some of the issues like storage facilities. Because of the large amount of money that is involved in establishing storage facility, most of our farmers are still not able to store their food or when after production. And then the issue of ensuring food crops is also still a challenge in Nigeria. And then when we look at even the agricultural production, sometimes it's mostly depend on rain. So there's usually good harvest, sometimes bad harvest, and which also lead to low revenue for even the farmers. Look at it, as I said, the logistic and the energy, which are supposed to be supporting farming, and also which means the yield is also still very costly, directly or indirectly through inputs costing. So relative, once there's high for the value chain in prices, it's actually those in between, that is the middlemen who buy from the farmers or the aggregators who buy from the farmers. So at the bottom line, when we experience food prices, it's actually not coming from the farm, but rather the middlemen that are in between the farm and the market.
Thank you.
And then another problem, because we are still not we have not improved in our innovation as required. Many private sectors are not participating, or they are not willing to invest in innovation. And even the research institute that are supposed to bring out innovation that will improve agricultural production are on researches, and we don't invest in research to Nigeria stakeholder, which is necessary for endogenous development paradigm. So I think the high cost usually translate to high farm gate prices, and then we threaten food insecurity on the side as well. Farm usually could have stock. So these are all key. And if we actually want to stream down on some of these factors, we can just say, okay, let's look at bad roads that usually the transporter has to pay high transaction in order, and this we can increase logistic costs, which is passed down to consumers of those crops. And then the storage issue, as I said, is that for example, the report of the Nigerian Economic Summit Group says that about 60% of wastage come from fruits, vegetable, and the rest, while between 5 to 20% still come from grains. So this means that Nigeria, we have not actually moved in the right direction to actually do something about our storage facility to eliminate waste after harvest. We still lack cold rooms. We still have lack good warehouses. And then, as I said earlier, the insecurity aspect is one. And then we also have issue of waterways insecurity, which is the irrigation. Most of our farm produce are rain-fed, and it is reported that only 1% of the cultivated land is irrigated. So which means we still have we are still 5 behind when it comes to modern technology in like irrigation facilities. And then,
Thank you,
is it 5
Professor.
minutes?
Yes, we've
Yes.
run out of time. Thank you. We provided very useful insights on how inflation affects the agricultural sector and how the role of subsidy has, affected both the cost of food, subsidy business, other aspects of the agricultural sector. So thank you for that. Um, let's move on to Dr. Samson Simon. So Samson Simon will bring in perspectives from household welfare, consumption baskets, and retail realities. Samson Simon, please. You have the floor.
All right. Thank you, Mr. Moderator. Ladies and gentlemen, I'm Dr. Samson Simon. Like Dr. Riley mentioned, I'll be talking about household welfare, consumption baskets, retail realities. If you look at the inflation numbers that came out yesterday for the month of July, the direction of travel, particularly for headline inflation, core inflation, might not be bad. Unfortunately, the core part of inflation is largely discretionary, particularly when you compare it to the food. And for the food inflation, the direction of travel is not only wrong, but is scary. And we know the way our country, Nigeria, is, and particularly for households, majority, there is so much poverty, whether absolute poverty or multidimensional poverty is just too much, and sadly, is getting out of hand. And the more inflation accelerates, particularly food inflation, which affects low-income households more than middle income and high income households. How? Because for the low income households, they use more than half of the income on food. And even before now, it's not like they had the best of food. They were just basically trying to make do. And now that inflation, food inflation in particular, is accelerating unabatedly, it's still going to be worse because they'll be squeezed to even manage far more than they were managing before now. And that means lower food quality for them, lower quality of products generally, because inflation is not just limited to food, but particularly for food. Maybe you go from branded to unbranded, you go from going to supermarkets to village markets, and maybe if you were going to village markets before, you have to go more inwards, more into the hinterland to see if you can have the requisite nutrition or calories for the day. And of course, trying to have a balanced diet would be close to impossible, particularly for low-income earners. So their welfare will be drastically reduced. And then the consumption baskets, of course, will change. It means food will have more weight now that food inflation is accelerating. And that's not really good because food is a basic necessity. And globally, the spending on food is a tiny fraction of overall spending. But when you're already using 65% of your income on food, and then these food prices keep spiking, then we are reaching crisis situation. And that's why the United Nations said that in the lean months of 2026, 35 million Nigerians will face acute hunger. That means they'll be in crisis situation, and in some cases even famine. So this particular piece of news it doesn't augur well for Nigerians, particularly the low-income earners who are struggling to feed themselves. And the social safety nets in Nigeria are not well developed and cannot really cater for the most vulnerable the way it should. So that doesn't really look good for the most vulnerable in the Nigerian society. And then for retail openings and shops and offices around, of course, the patronage, particularly for those low-income earners, because they are going to be priced out when it comes to a lot of products, particularly the branded products. If you're buying spaghetti or macaroni or even backed rice and so on, you expect less. If before they were struggling to buy those items, you should expect less and less from them. So it's basically going to be the middle-income earners and the high-income earners that will still be patronizing the sophisticated supermarkets, particularly in the big cities. So purchasing power has been reduced. It has been chipped away at because inflation has been unabated, and it has really diminished the capacity of Nigerians to buy necessities, not even luxuries now. And then brand switching, of course, is an obvious thing. Even for middle income earners, even for salary earners, it's not going to be easy for them. So they will likely switch to less qualitative brands because what they used to afford, they cannot afford as prices keep climbing. So that's the situation for the average Nigerian, and it doesn't really look good. Thank you.
Thank you very much, Dr. Sampson Simon, for those insights on how it affects household welfare, poverty, and the issue of lack of safety that's within Nigeria. Thank you, Dad. So we move on to the questions from the moderator, myself. So I'll be giving pointed questions to each of the moderators, and we're expected to answer them within 3 minutes. So I'll start in the same order that I used to ask for the presentations. So I'll start with Musi. And the particular question is that given the July 2026 print, should asset managers aggressively shorten the duration in fixed income, or is the market already pricing in a structural peak?
All right, thank you very much, Doctor. Thank you very much, sir. So when it comes to duration, right, if you look at Nigerian's yield curve, that is the bond yield curve, you will see that the curve has been inverted since 2024. As a matter of fact, much more inversion happened in 2025. And the reason was because MPR was raised, and when monetary policy rate is increased, it affects money market first, that is OMO and treasury bills. However, on the bond curve, it affects the short end, that is short maturities, before it affects the long maturity. So right now in Nigeria, 30-year bonds are paying lower yield than 2-year, 3-year, and shorter dated ones. So when we are thinking about the fact that there's still threat of inflation, right? What investors would typically do, and that's what we are seeing in the market right now, except for some sort of support on the fiscal side, investors are essentially looking at holding near money, because when the expectation is that inflation will remain somewhat elevated. Yes, the trend has been going downward, but like I mentioned, it's still going to remain sticky at over 15%. 1% month on month or 1.5% will take it way higher than even 16 or 17% before the end of the year. So what duration play is happening at that point in time is that right now, a lot of investors will be taking position on the short and mid end of the curve, while on the long duration part, those are mostly for PFAs that have patient capitals, because when it comes to the market, it depends on the position you take is dependent on your strategy. So if you're a tactical client or if you're a tactical investor want to make money on price appreciation. As a tactical investor, I don't mind if even interest rate is 1%, because all I want is when I buy at 1%, interest rate goes to 0.5%. From 1% to 0.5, I will make money on price appreciation. So when it comes to tactical move, we don't care about the level of interest rate, we care about the direction. However, when it comes to strategic investors that are taking long-term, PFAs, they would want to buy long-term. And that's why you see that the long end of Nigerian yield curve is depressed, because the PFAs are sitting at that point, at that place. So, but when it comes to the money market, now that we saw a recent policy by the CBN that has allowed everybody to participate in the OMO market compared to what it used to be, and what led to the restriction happened in 2019, when Nigerian loan to deposit ratio declined massively. What that means simply is that banks were loaning to private sector because they could buy OMO easily. It's always easy to just put your money in OMO, and you don't have to lend to one SMEs or any private company that you would have to begin to grapple with non-performing loans or bad loans. But because the CBN saw that, we saw the restriction. But now that the restriction is lifted, and over time, there's always premium of OMO over treasury bills. Right now, the premium is about 100 basis points. So it therefore means that investors will prefer OMO to treasury bills. And when it comes to, like I said, when it comes to the bond curve, you would want to do short to mid end of the curve. And if you also think from the inversion of the yield curve, because it's inverted, it means it can happen in two ways. Either the long end of the curve increase in yield, which means people that hold long end will lose money if you're tactical, while short end declines.
And the final point is on Eurobond, right? The Eurobond market as well is the yield has compressed significantly. That's because interest rate has risen in the US to around 5%, while in Nigeria, interest rate has declined. That means the risk premium has contrasted significantly. So it therefore means that anybody that wants to do long duration in the Eurobond market may be playing with a lot of risk, but it's better to stay on the short end of the curve, even though the yields are around the 5 to 6%. So by and large, because of an elevated inflation expectation, duration play is short rather than long, and it also depends on your strategy. Thank you.
Right, thank you very much for this insights on inflation and the yield curve. I will move on quickly to Dr. Islamuddin with a specific question. Does this CPI trend suggest that traditional interest rate hikes is a wall of diminishing returns and curbing Nigeria's current liquidity? Does this CPI trend suggest that the traditional interest rate hikes is a wall of diminishing returns and curbing Nigeria's current liquidity? So it's not again.
Okay, thank you very much, Doc. I think in part I tried to address those things in my earlier submission. Now, first, we need to agree on the fact that we need to agree on the fact that the disinflation trend that we have seen over the last few months in terms of the uptick in inflation, but at a disinflationary stage, is being challenged, especially given the trend in food inflation. And with respect to the efficacy of interest rate hike vis-a-vis challenges with liquidity, I think we have to look at it from two perspectives. Number one, from the perspective of liquidity management by the central bank, I think central bank has done well, even though I may not necessarily agree with the impact that it has had, but to the extent of taming liquidity within the deposit money banks, like I said earlier on, with hike in cash reserve ratio to 45%, and with consistently elevated MPR, currently at 26.5%. What this has succeeded in doing is, number one, yes, liquidity has been tamed, but banks are still highly, highly liquid. But where do they deploy that liquidity? That is when you look at the impact on the fiscal side. The banks do not deploy that liquidity into productive sectors. They don't support growth. And more so, you may not necessarily challenge because they are private sector driven. They are owned by individuals. So they look at motive, their primary motive is their profit. And should they, at this kind of depressed kind of economy that we have managed over the last few years, should they lend? At what rate will they lend? They lend at 30% plus percent. How are they sure that they can be able to recover their money? So that is a challenge in terms of credit risk, no matter the collateral arrangement is involved. So what options do they have? The attempt by the central bank to tame liquidity, to address issues related to inflation, to manage exchange rate in terms of stability, has supported in incentivizing not foreign portfolio investment. It has rather incentivized foreign not foreign direct investment, but it has rather incentivized foreign portfolio investment, which is short-term funds. That is why when you look at the trend, like the earlier speaker said, in terms of the bond yield over 30-year period, you see that it is very low, but very high. When we look at it like a 2-year, 1-year bond, you can see the interest very high. People just, those investors just come in to take advantage of the opportunities that we have. Had this addressed our problem? No. Has it supported the central bank in terms of stability in exchange rate? Yes. Is it permanent? No, it's temporary, because when you look at the trend in terms of the foreign reserve is majorly monies based that come in as FDIs, not FEIs. When will they go? When will you have that stability? Now, is there any kind of synchronization in terms of relationship with the fiscal authorities? The answer is neither here nor there. The authorities will say they are now talking, unlike before when the fiscal authorities were over borrowing ways and means and so on. I don't know whether the fiscal authorities are still not borrowing, because when you talk about NRS talking about meeting up with their revenue target, and you can see the pattern of implementation of budget, then you begin to ask where the money is. So my own take is we will continue to see uptick in inflation. CBN might not be able to, they were able to raise their expectations, or rather reduce their expectation from hitherto 9% base rate to 12% plus. But I do not think they can be able to meet up that again because of the base effect and also other challenges beyond the control of the monetary authorities. Thank you.
Yeah, thank you very much, Dr. Islam, for these one insights and for your stance that the inflation is in the near future. So I move on to Professor Gimba Kari with a specific question. With inflation straining real budget allocations, what immediate adjustments must the fiscal authorities make? Capital expenditure timelines. What immediate adjustments must the fiscal authorities make to capital expenditure timelines? Professor Gimba.
Okay. Yeah, thank you very much, Doctor, the moderator. Well, with inflation training real budget allocations, fiscal authorities must take the following steps to make capital expenditure timelines. 1, adjust capital releases periodically. Rather than treating the annual budget allocation as a fixed amount throughout the year, government should review project costs periodically and respond to significant changes in inflation. Because leaving project cost just the way it was budgeted, it might be unrealistic because of inflation. Number 2, prioritize critical projects. Projects that are already substantially underway should receive priority to do so that public resources are not wasted through abandoned and delayed projects. You know, sometimes government will misplace priority projects that have direct bearing to the citizens. Government might not be interested, but they might have projects that, you know, that might benefit them directly or indirectly, so to say. And number 3, avoid excessive monetary financing of deficits. Fiscal authorities should reduce reliance on financing arrangements that can undermine efforts to control liquidity and inflation. Number 4, strengthen revenue mobilization. Nigeria needs stronger and more predictable non-oil revenues so that essential public expenditure is less dependent on borrowing. The next is address the supply side cost of inflation. We all know that food production, electricity, transportation, storage, security, and infrastructure must be improved. We are lagging behind on all these sectors. Monetary policy can moderate demand, but it cannot produce more food or repair roads. The cost of living challenge requires coordination rather than isolated policy. Just like I said earlier, monetary policy should control inflation, while fiscal policy should protect public value. And structural policies should increase production and reduce cost of doing business in Nigeria. Ultimately, the success of government policy should be measured by whether public resources deliver real improvements in the lives of Nigerians, not just because of maybe political gain. A project will be enacted or a project will be built in a place or somewhere just because of political interest. Our objective should therefore be simple: spend better, borrow responsibly, produce more, and protect the purchasing power of citizens. Thank you.
Thank you very much, Professor Gilbert, for those well thought out measures. We move quickly to Dr. Modestus on some specific question. How can consumer goods companies re-engineer their procurement strategies to survive a prolonged core inflation crunch without triggering the demand collapse? Repeat, how can consumer goods companies re-engineer their procurement strategies to survive a prolonged core inflation crunch without triggering demand collapse? Dr. Modestus.
Thank you so much, moderator. If I can understand this question, I can translate it to mean, how can consumer goods companies reduce their cost base without simply transferring the entire inflationary burden to already stretched Nigerian consumers? I am going to approach this into 4 strategic shifts. Number 1, firms should move from cheapest supplier to lowest sustainable cost. In a prolonged inflationary environment, procurement should not focus only on getting the lowest unit price. What questions companies should ask themselves are, can we source input locally? Can we diversify suppliers? Can we reduce import dependence? Can we negotiate longer-term contracts? Because when you do that, it will spread the effect of inflation. Can we redesign specification without compromising quality? Can we reduce logistics and warehousing costs? So the cheapest supplier is not necessarily the cheapest supply chain. A supplier offering a lower price, but with unreliable delivery, high transport costs, or foreign exchange exposure may actually be more expensive. Like I said in the earlier this when I was discussing the first part of this
Nobody to keep it. Amen.
So procurement need to be looked at total cost ownership, not simply invoice price. That is how much it costs you to bring this input into your factory, and not how much you bought it, how much invoice price that was given to you. The second approach is build an inflation resilient supply chain. This is particularly important for Nigerian goods, consumer goods companies. They should identify their critical inputs and classify them according to cost risks, supply risks, and import, that is foreign exchange exposure. For example, imported raw materials has high cost risk and equally has high supply risk. So the best strategy for that is to localize or diversify your source of supply. Then when you talk of packaging materials, it has a medium cost risk and a medium cost supply risk. Then you can look for alternative supplier. Then for energy, we all know that it has a very high cost and it has a very supply risk too. So alternative source of energy will be advised, like solar and all the rest of it. So for local agricultural inputs, number one is that the cost risk is medium, yes, we know. And then the supply risk is, we know that it's seasonal, so you can't be relied on. So you can now, the strategy response there is that you can liaise or partner with the suppliers so as to make these inputs available. You cannot manage inflation if you don't know where inflation enters your supply chain. That one is taken as given. So companies should develop an input cost dashboard rather than recycling only on the monthly CPI. You don't wait for what CPI says or this thing. When you're able to know where this inflation is entering your supply chain, then you tackle it appropriately. So the third approach I will give to this is use smarter pricing instead of blanket price increases. This is probably the most important part. When you increase your costs, when your cost is increased, prices will go up. And in a cost of living crisis, when you increase your costs, of course, the purchasing power is reduced, and then the demand for your product is equally reduced. So companies need to do selective price pass-through. Instead of increasing everything by the same percentage, one, they can protect prices on highly price-sensitive products, adjust prices more on less price-sensitive products. That is those particularly the essential goods. So you try to balance and know how you adjust prices on that, not just increasing your prices just across the board. You offer different pack size. Yes, you can now redesign, have small pack size of your products so that they can be affordable. Then introduce value-oriented products, and then reduce unnecessary product variation, and then use targeted promotion rather than across-the-board discounts. So the question is not simply how much we can increase prices, but how much can we increase prices before consumers change their behavior? Yeah, like I said before, if you increase your prices unnecessarily, consumers automatically will look for alternative substitutes, Then the fourth is to protect the consumer while protecting your margin. Consumer good companies should not think only in terms of how do I protect my margin. Rather, they should think of how do we protect margin while preserving consumers' purchasing power and volume. That is the turnover. This requires looking at margin per unit and margin per customer volume. For example, a product price, a product that costs 1,000 naira, that is the selling price is 1,000. A unit cost is 700 naira, for instance. So the margin is automatically 300. If the company increases price to 1,200, the unit cost automatically will be 800. Their margin will increase. That looks very attractive, you know, but the volume falls by 30%, which automatically will go along with reducing that profit margin you are looking at. You know.
Thank you.
So, in a very short distance, just to be brief, a high unit margin does not necessarily mean higher corporate profitability. So that will not take us to demand collapse trap. Thank you.
Thank you, Modestus. Thank you for those useful insights on the supply side cost issues. And I'll move to some policies and what's critical policy and the government introduced this month to decouple food transport costs from broader energy sector inflation.
Good afternoon. Thank you for that question. Even though we are dealing with food products, I'm wondering what government should do now this month, as you said. We are in the planting period, and across some of the states in the north, some governors are already distributing fertilizers and other farm inputs to farmers. I would suggest that the government should complement the distribution of fertilizer with some farm equipment so that it can complement the high quality rural roads and affordable prices. And then I also would suggest, since it's this month, we can say both states and federal and state government should actually put in mass transit to actually reduce the burden on fixed income earners, so that that will actually enhance the purchasing power as with the current food inflation rate. And then I also said maybe both government, federal and state government should complement each other, but actually for opening up alternative routes like the waterway system, transportation system, which we have great potential. We have not actually explored that avenue to complement the road transportation. I think for the riverine area, we can actually complement road transportation with water transport system. And then I will also say we can immediately, when you travel along the northern Nigeria state, especially when you're moving from Kano, Kaduna, Jos to Abuja, you see many checkpoints with trunks carrying a lot of loads, and they are being taxed. So if we can actually ban these illegal checkpoints along the way, because the more money they give when transporting these goods, the more the transportation costs rests with the farmers who actually is transporting the goods. And also, we also said maybe we've already have some projects of railway lines. Maybe we should facilitate the railway integration between states like north and south, so that the ease of transportation will actually bring down the logistic prices, and the railway integration will actually reduce the transaction costs on farm produce when they move across states in Nigeria. So for now, this is what I would say, since you said this month. But we could look at short time and mid time and long time perspective when we're discussing such issues. Thank you very much.
Thank you
I
very
rest
much.
my case. Yes.
Yes, thank you very much, Professor Samatu. Very, very useful contribution on how to look food aspect. Then we'll move on to the last panelist, know where it is, and Dr. Samson Simon. And the specific question for you is, does households aggressively downtrade to informal options? What structural changes are we likely to see in informal retail employment over the next quarter?
Thank you. These inflation numbers are no good news to anybody, but particularly for retail outlets, because it means that they'll be facing, or they have been facing, this just confirms what they have been facing, double squeeze. The consumers, the buyers that come to their stores, their purchasing power has been chipped away at. They have less capacity to buy what they used to buy. And for some items, they might have even been priced out, meaning that they cannot even buy at all. And even in cases where they can buy, they buy less numbers than they used to buy before, or even sometimes they opt for other options, cheaper options, less qualitative options, or lesser brands than what they used to. For the retailer, it means less revenue. It means less patronage, which is not good news. And that's on one hand. On the other hand, as a retailer, you also have inputs, and it means the prices of these inputs have gone up, whether they're really the products you sell, or the fuel you use, or even the rent that you pay. So basically, these retailers have been squeezed. And since they have been squeezed, their capacity to get things done is highly diminished. And when their capacity to get things done is diminished, it means that they may have to reduce the number of staff, or even if they wanted to recruit before, they would think twice. They would delay it, suspend the recruitment for now. So basically, it's not good news for the retailers, and it's not good news for the economy if such things are happening. So basically, that's what I have to say. Thank you.
So thank you very much, Dr. Sampson, for those facts. And also thank business pricing, protection of real incomes, tribal monetary policy, fiscal discipline, and lower food production and distribution costs must work together to solve this inflation, rising inflation. So on that note, I close this session, and I thank you all for your attention. Yeah. It's just Dr. Justin, are you there?
Yes, I'm here. Moderator, can you check the portal where questions are supposed to be warehoused? Then you can look at the questions there, and you direct them individually to the respective panelists.
Okay. I'm yet to see.
Okay. If there are no questions, we move to the last segment. Moderator, you are to give us a brief recap of the key issues the panelists have discussed, even though you are giving it while they were discussing, but this is a recap, a summary of what are the key points. Of course, the chairman of the FCT chapter is going to give us a final takeaway from the discussion overall. But you can recap based on what you consider are the most critical issues that have been highlighted in the discussion.
Now, I think I've been saying that there is no one instrument that could solve the rise in inflation. We need a combination of smarter business pricing, protection of real incomes, credible monetary policy, fiscal discipline, lower food production and distribution costs to work together to solve the rise in inflation. So it's the combination of all the instruments and policies mentioned by the panelists, in different magnitudes, should be combined to solve the rise in inflation in Nigeria. And that is the main takeaway from this conversation. Thank you very much.
Thank you very much, moderator. Well, at this point, I want to extend my sincere appreciation and gratitude to the moderator, the panelists, and also, and most importantly, our digital audience that have made this a worthwhile experience for us. I will now hand over the floor to the FCT chairman, who will now give us a summary of the key takeaway from the conversation. Chairman, the floor is open to you.
Dr. Amasi, and I want to appreciate all the panelists for a job well done. I give an applause from here. The reviews have been very unique, and we have learned so much from the analysis. There are a few takeaways I have from my end. A lot of them gave different perspectives to these issues on ground. From Dr. Temitope, he actually analyzed the issues for us, and he concluded that there are key factors that actually affect this, and he enumerated one of them as energy shocks, monetary supply, exchange rate, energy prices, and all these exchange rates affect CPI. So I think what we should do is for CBN to do is to maintain a very restrictive but data-driven or dependent MPR, strengthen macroeconomic and monetary policy credibility by maintaining positive REs, ensuring that transparent and market-responsive sovereign fixed income pricing and reducing national capital flight risk, and through exchange rate stability and predictable fiscal management. So we just they have to do this in order to ensure that, because we notice asymmetric in the inflation report, where this the core inflation rising and decreasing, and where we have food inflation, increasing. So it's very asymmetrical. So if they put this in place, I think it will stabilize the system to some extent. Talking from Dr. Riwan, adequately right. So he talked about food inflation, and what we need to do. So from his perspectives, actually, before I actually move from Dr. Mosri, he actually mentioned that he predicted that there will be a kind of uptick as we proceed next month, and towards the end of the year, that there will be an increase in month-to-month to 18%, and headline inflation to like 15.8%. So we look forward to see how that come to pass. Okay, so now looking at Dr. Riwa's submission, well, we noticed that what actually transpires is that the monetary policy is not effective, for supply-driven food shortages. So it's not very effective due to some structural issues. So, and to approach this, there should be enhanced monetary policy transmission, by improving liquidity management and ensuring that CBN policy rate adjustment effectively translate into lower credit spreads and affordable lend rates. So if this is done, then we're going to see a kind of improvement in the CPI, even from both sides. Yes, moving to Professor Gimba Kiari, right? Yeah, Professor Gimba Kiari on a fiscal policy condition and structural deficits. Yeah, his key submission was based on wrong assumptions, wrong budget assumptions, right? So, and when this happens, you predict, we're going to have so much in terms of budget inflow, and because it's not realistic and it's far from the target, then we end up borrowing. Okay, so when that happens, then it increases it leads to a expansionary system which equally affect the inflation that monetary aspect is trying to correct. So we have to get the assumptions right, and especially when we borrow, then we should ensure there is enough productive capacity to absorb it. Otherwise, we have that expansionary gap, which we conflict with what the CBN is doing on the side of demand side, on the side of monetary policy. So what we should do here is to strengthen fiscal monetary policy coordination, by adopting realistic budget assumptions and enforcing expenditure discipline and implementing a credible measure-time strategy to contain debt servicing pressures and reduce the inflationary impact of especially the fiscal policy. So because that has to be done in order to maintain balance between fiscal policy outcomes and the monetary policy outcomes. Going to Dr. Modestus, he extensively talked about how CPI affects the input, that is the input mix of producing the companies, and that is why we see this uptick, and why the headline is coming down and the food inflation is going up, because the mix is affected. So the mix is affected, so it affects in the long run. So in order to properly organize this, we have to look extensively into the mix going into the production. So how affected, how insulated are they? Are they insulated from this inflation? No, it's affecting them. The monetary policy, does it affect those the input from the farming produce? It doesn't. So talking about these structural shocks from farm, getting the logistics, all those things affect the input mix of those companies. So companies that are producing food, they get the food from the farm, and there are logistics challenges here and there that the monetary policy cannot, defend. So in that wise, we have this imbalance where the mix that goes into production will not be tamed. There's no way the monetary policy can affect it, and that is why we still experience the surge in food inflation. So, in other words, the CBN should try and support fiscal policy that promotes supply chain resilience, through local sourcing, strategic inventory management, and cost-effective procurement to reduce input volatility and protect corporate margins, which Dr. Modestus really explained. So that has to be done because, like he said, at this moment where we have this high rate of inflation coming to food aspects, if a producer had just bought some items, he had just put it to production, and by the time if he has enough stock, that enough stock is a big risk to him, because by the time, especially those slow-moving goods, by the time he will exhaust getting to the replacement margin, when he's supposed to do replacement order, then he discovered that the price has gone up. So he will have no choice than to increase his prices, and that will affect the balance. So they should find a way, the CBN should find a way of supporting fiscal policies that will promote such development. Going to Professor Salamatu Idris Isa, she actually spoke extensively on this area. We have storage issues. She identified storage issues, insurance problems. How insured are those farm produce? No silos in place. So how many silos do we have in Nigeria? That from here they store. So it's from the farm to the market. So when there's this shock, you cannot absorb it, and that is why we have this issue of food inflation, going up. There's no storage. They are not even insured. So farmers will produce and bring their produce to the market just to sell at all cost. So of course, this in a way will bring the price down. But at the point where there's scarcity, because there's no storage capacity. So when there is scarcity in the market, then we now have issues of this price skyrocketing. Now, like I want to support Dr. Mosui, because I foresee that maybe towards December there may be an increase in food inflation as well, because we have what we have now. It's still moderate because this is harvest season, and as we approach December, some farmers will even store and they won't want to sell. So we may experience an upsurge in food inflation towards the end of the year. So what we do in this area is to strengthen agricultural logistics, by improving transport infrastructure, reduce energy costs, incentivize food storage. If possible, let the fiscal policy should look at how to support, building of silos all over the country, where we can have a reservoir of food to avoid food inflation, going forward. So we will move to Dr. Samson now. Dr. Samson spoke extensively on on household welfare, consumption baskets, and retail realities. And he emphasized how inflation has really eroded the purchasing power, of the citizens. So it is really sad that while we're experiencing headline inflation coming down, inflation coming down, the food inflation, which affects, of course, this affects the people at the lower rung of the economy. So it affects them more, and they are more in number. So more than, like he said, that more than half of their income goes into food consumption. So they cannot even save. So, and this has led to lower quality of food, because and this is affecting their welfare. They can't get what they actually want. They can't. It's beyond their reach. So they settle for less. They use more money to settle for less and less quality food. So this is not good on their heads. So the CPI is indicating that we need to do more on the supply side of the economy. So what we need to do is to strengthen household purchasing power, through targeted social protection and lower costs on essential goods. If this is possible from the fiscal policy side, we can see the way they can produce and they can support. Of course, we don't have one thing that is lacking in Nigeria is there's no price control. So everybody at their volition, they just increase the price, and there's nothing you can do about it. So the government should find a way of probably, VAT is also high. So, and the government is also looking for, from fiscal side, how they can earn more money through all these, through VAT, through taxes, and they are getting this, but it's not actually translating to the improved welfare of the people. So they have to adopt a coordinated economic, macroeconomic policy that will manage the monetary and fiscal side with supply side reforms, have stronger domestic production and logistics, and effective liquidity management and targeted social protection, to stabilize prices and all that. So in this wise, the purchasing power of the citizen can just can improve, even at least to commensurate with the uptick in food inflation. So on this note, I just want to thank you all for your input. The webinar has been very productive. I just hope that the policy recommendations here will get to the right authority and see how it can be of help to them. So I thank you, and God bless you.
Thank you very much, FCT Chairman, Dr. Agunleye. At this point, let me thank the moderator and all the panelists, as well as all the members of the audience. I think you made this high impact session very memorable. Unfortunately, we could not get questions from the audience, which is supposed to be the case. Questions indicate that you are actually following, and there are areas that you need clarification about. And they also mean that you have inputs that you can make that are different from what has actually been discussed. So subsequent events, I encourage all members of the audience to prepare questions, even ready ahead of the presentation time, so that we can share the questions and the insights and enrich the overall experience of this kind of conversation. On behalf of Macrostrat Nigeria Limited and the Nigerian Economic Society FCT Chapter, I wish to thank every one of you and request that you can check your chat box. There you can click on post-event survey and help us to give a feedback, especially as you have not given us questions and observations. Give us a feedback about the session and what we can do to improve it subsequently. I also want to assure you that in 48 hours' time, the policy brief of this session by Macrostrat and Nigerian Economic Society will be in your inbox, as well as the script, the video of it. So once again, thank you so much, and I wish you a very happy week ahead. Thank you all.
Thank you.
Thank you very much.
Thank you, sir.
Thank you for the opportunity. Yes,
thank you, everyone.
We look forward for more engagement like this in the future.
Absolutely.
So much. Thank you so much.
Thank you so much, the moderator.
Thank you.
Nice seeing you again.
Thank you, Dr. Chikika.
Yeah, thanks, Elizabeth.
See you at next. I hope all of us will attend next.
Yes, we are coming.
All right.
Yes, we are coming to Abuja for next conference. So prepare a place for us.
I have another session in September. We forgot to announce the Nigerian Economic Society annual conference. I think FCT Chairman would have done that, but we have all forgotten. I think we'll be able to remember that if we have another session before the conference starts on the 7th of September. Thank you so much.